This trader is nothing short of a trading wizard. He claims that over the past few years, he's completed nearly 1,000 trades, maintaining a success rate consistently above 84%. Initially, I was a bit doubtful, so I decided to look at the data myself, and to my amazement, it seems to be true. The most impressive part is that, in the first half of the second and third years, his success rate actually remained stable at around 95% for 6 months. Delving into his core strategies, particularly his methods for entering trades and setting take-profit and stop-loss orders, I found his entire trading process to be both simple and unique. It's a pity that I've only discovered such a trading master now. Don't forget to check the subscribe button, and the story is just beginning. His name is Derek Dargo. He grew up in Sri Lanka in a happy and affluent family with his father working at the Polish embassy. In the early 1990s, when Poland emerged from Soviet control and reopened its stock market, Derek, by chance, was introduced to it and found himself deeply attracted. Even though the stock market was a whole new world to Derek, his curiosity led him to purchase 100 shares of a particular company, embarking on his first trading venture. He later shared that this initial investment, nurtured over many years, grew to yield more than 5-fold returns. Subsequently, Derek ventured into entrepreneurship, founding an import-export business. His operations were diverse, involving the movement of Chinese products to Germany and Polish goods to the UK, making his days bustling with activity. In the midst of this, Derek made an insightful observation: international trade often required currency exchange, like converting RMB to USD or euros to USD. He noticed that strategic timing and currency exchange could enhance profits, especially when dealing with larger sums. This insight was a turning point, highlighting the real impact of currency fluctuations on tangible financial gains and losses. Armed with this knowledge and his stock trading experience, Derek's interest in forex trading deepened. By 2008, embracing his passion for the financial markets, he closed his business to dive into trading full-time. He initially focused on forex and stocks, and as the financial landscape evolved, he also explored the burgeoning world of cryptocurrency. Initially, Derek used over a dozen indicators to assist his trading decisions. However, this was like asking 10 people for advice and trying to find consensus among their varied responses. He often found himself hesitating, and his trades were not smooth, with his account showing little progress over a long period. This changed when he discovered a unique combination of price action and a special application of MACD, which significantly improved his success rate, setting in motion a turn of fortune. Derek named this the PA+MACD strategy, a methodology divided into 3 steps. The first step involves identifying key supply and demand zones, or support and resistance levels, on a 4-hour or longer time frame. Support and resistance are pretty self-explanatory. Any area that effectively provides support or resistance to the price movement is considered as such. Supply and demand zones are areas where large institutional investors operate, capable of causing significant price fluctuations. These investors often place a large volume of orders within certain ranges. If only a portion of these orders are filled before the market moves, these zones no longer offer favorable conditions for these investors, and they wait for the price to return to these target zones to resume trading, unlike retail traders who may chase trends. We subjectively believe that 4 types of trend structures fit the concept of supply and demand zones. These areas indeed often act as points where price movements pause or reverse. The identification of demand zones involves 2 structures, a drop-flat rise and a rise-flat rise pattern. The drop-flat rise refers to the market first declining, then stabilizing, and finally ascending. The small plateau before the market reversal is the demand zone we seek. When prices approach this zone again, if there are still many unfulfilled orders, they might prevent further price declines. The rise-flat rise, on the other hand, indicates the market first rising, stabilizing, and then continuing to rise. This usually represents a brief exchange of positions between bulls and bears within a trend, after which prices continue to climb. The plateau in this rising phase is another type of demand zone. Supply zones include rise-flat-drop and drop-flat-drop trend structures, marked and identified in the same way as demand zones. With these potential price stalling areas identified, we can proceed to the second step, verifying the validity of these zones. The second step involves looking for standard Harami engulfing patterns or pin bar engulfings near these potential reversal zones. These price formations are key indicators. The third step is to use MACD as an oscillator. We enter MACD in the indicator search bar, add it to the chart, and adjust the settings to keep only the histogram using the color settings I've provided. The dual-colored histogram confirms directional changes. A switch from green to red suggests a bullish to bearish transition, and red to green indicates a bearish to bullish shift. The peaks and troughs of the MACD must be well-defined and not too flat, maintaining a regular pattern rather than an erratic alternation of colors. Taking the 4-hour Bitcoin chart as an example, the rules for entering a short position are as follows. If, during an uptrend, the price approaches a supply zone and exhibits a triple candlestick harami engulfing pattern, this indicates market hesitation and a small range consolidation, signaling preparation for the next move. When the price breaks below the low/closing point of the engulfing pattern and the MACD shifts from green to red, all conditions are met. This suggests a likely resistance encounter and a subsequent downtrend, making it suitable to enter a short position at the closing price. Conversely, the rules for entering a long position are as follows. During a downtrend, when the price reaches near a demand zone and shows a standard pin bar engulfing pattern, it indicates that the price has difficulty breaking through this area due to unfulfilled orders or strong buying interest. Once the price leaves a long lower shadow and breaks above the high of the previous candlestick with the MACD transitioning from red to green, all conditions align. This predicts a potential price rebound, and it's advisable to enter a long position at the closing price. For stop loss, he positions it slightly above the supply zone or near the lower end of the demand zone. If the zone is too broad, he might place it at the end of the entry candlestick. He doesn't strictly aim for a risk-reward ratio of 1 to 2 or higher, as the stop-loss range on a 4-hour chart is usually not insignificant. With a larger space, the risk and uncertainty increase, so he prefers to take profits near key areas. His risk-reward ratio is often below 1 to 1, as he believes is high and stable when rate compensates for it. Alright, don't forget to hit the subscribe button so you won't miss out on more profitable trading contents. I wish you a good morning, good afternoon, and good evening. Goodbye.